Hi, in this video we'll cover the market segmentation theory. So as its name suggests, the market for short-term investing and the market for long-term investing are two different markets. So there is no direct link between any of these markets here. So intuitively, if I save for 4 years, it has nothing to do with the decision or the preference of saving for 5 years, 6 years, or even longer periods. Each maturity is a different market on itself. So the different spot rate is simply determined by the supply and demand for that maturity. So if this theory is correct, then it's plausible for us to see all sorts of different shapes of the term structure. So it could be upward sloping, it could be downward sloping, and it could be relatively flat. Okay, so this is probably the most flexible theory among the three theories that we have covered here. Okay, and this should conclude the part on the term structure, and I will see you in the next video.